Hi, I'm attorney Glenn Wagstaff. I want to share some thoughts with you related to capital gains planning. And specifically, if you own a farm or a ranch and at some point in the future you're thinking about selling those assets or maybe a business interest, we've even had individuals that owned like an oil tank or some of their farming equipment that sold for highly appreciated values. And how do you plan around some of those taxes? Because capital gains taxes can add up very quickly. And even though capital gains rates are lower than your income tax rates, it can be very large because we're talking about larger numbers. So for example, when you sell your home, you have a $250,000 exemption if it's your personal residence per person, right? And when you sell your home, you might have purchased it for $100,000 and sold it for $300,000. So all of the difference in those gains is what you're going to realize for capital gains taxes. It's the same thing if you sell a farm, or if you sell land, or if you sell a business, or if you sell anything. Whatever you put in is what's called your basis. You get to exempt that from taxes. But whatever the growth in the value is at the time that you sell, that's what we call your capital gains. And your capital gains are going to be subject to, at a federal level, a maximum of 20%. And then depending on what state you're in, you may have additional taxes on top of that. How do we get around capital gains taxes? Well, we actually wrote a book on estate planning for the exit, or tax planning for the exit. It's called Exit Richer, and if you're interested, we can get you a copy of that ebook. But in that book, we talk about three main strategies to be able to minimize the amount of capital gains taxes that you would have on a sale of an asset. The first one is what we call tax minimization. Tax minimization means that there are strategies that we can put in place that will help you to minimize the amount of tax that you're paying. Most of these strategies require that you actually have the structures in place even before you have a buyer, even before you have an offer in writing, right? And so it has to be done ahead of time. Some of these are specific to business interests. Some of these can be done with any kind of asset. And when we set it up, the intention is for us to be able to help to minimize the tax, but there are very strict rules and guidelines that go along with each of these structures. So for example, we have a type of strategy called a charitable remainder trust. At the time of the sale, you can avoid all of the tax on the asset that you sell. And then that trust is going to receive the proceeds, invest the proceeds, and the longer you hold on to the investments, the more that it's going to be able to generate over time, right? But every year, that trust is going to give you or your family an income stream for the rest of your life. If you're married, maybe it's joint lives for you and your spouse. And then you claim that as income. You will have some tax on that income that comes through. But the idea is that we take a portion of that and we replace the value so that when you pass away, we leave the full value for the family through life insurance. The combination of these strategies allows you to, instead of losing 20% or 30%, or depending on what state you're in, it might be as high as 40% of the asset when you sell due to taxes, we can instead actually take that value and triple it. You can live off of the full proceeds if you live for at least 20 years or longer, or depending on how it's structured. You live off of the full proceeds. At the time of your passing, whatever's in the trust is going to go to the charity of your choice, and it can even go to your own private foundation. And by the way, we can structure foundations that will help with promoting farming, with promoting agriculture, technology, research and development, all kinds of different things in that field. And we replace the value through life insurance for the family. So now we've tripled the value instead of losing 30% or 40%, right? So this is one of those strategies that could make sense for certain situations. We also have deferral strategies. In deferral strategies, we put the assets in a place where you don't have to pay the taxes up front. Now, a lot of people have heard of a 1031 exchange, but in a 1031, you have to reinvest in a similar type of property. We have alternatives to that where you don't have to reinvest in real estate or in the same asset. And then the third type of strategy is what we call offset strategies. And that's where we use deductions to be able to minimize and offset the amount of tax that you're actually exposed to. And we can do these even after the sale takes place. So we have a lot of solutions. We can sit down and look at what makes the most sense. I remember sitting down with one of our clients that was selling some farmland. They sold it for about 5.2 million, and they had purchased it way back when for about 1.6. So they were going to have some significant capital gains taxes. Because of the structure we put in place, we lowered their tax exposure by 80%. And that made all the difference in them being able to have enough for retirement, enough for the legacy that they wanted to leave for their family, and enough to be able to structure things the way that they wanted to for their future wealth and family's wealth. So if any of this is valuable, let us know. We'd be happy to sit down and do a complimentary consultation, and we'll look forward to talking to you soon.